Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. Of course, we are getting ready for the hotly anticipated Federal Reserve meeting. I will get us through all the narratives, the major things we need to be aware of. There are a lot of moving parts today, and I'll help us get ready so we can see the major issues we need to be aware of, as well as looking at some potential instruments which could be showing some significant volatility today. I'll show you what I'm looking for in my trading, and we'll take it from there. Don't forget, as we look at different entries, exits, the whole idea of this workshop, it's not that it's a signal trading service, but you're looking over my shoulders, someone with a professional trading background and a professional analyst, and you see how I'm going about making trading decisions. So the idea is this can hopefully help inform and help you to make wiser decisions as you understand the major narratives and the moving parts. So without further ado, we've got a lot to cover, so I want to get stuck into it quite quickly. Hey Max, good to see you. Good to have folks here. Really good to see some good names here today. It's lovely. Hashik, good to have you. Kingsley, Salah, Max, of course, Eamon, Eddie, good to have you guys here. Looking forward to the session. Just as other folks are coming in, we'll get going because this is always can be picked up in a recording. Now, with the interest rate decision, with all risk events, there's 4 questions you need to ask yourself. 1, what's expected going into the decision? Because it's only when you see a move away from what's expected that you get the tradable opportunities. So you need to know what's expected. Secondly, what will be the surprise? You need to know what would surprise markets. Thirdly, what's the big picture? That's very important. And fourthly, what's the instrument? Because sometimes you might have a surprise and it's unexpected, but it doesn't change the big picture. So because there's so many moving parts today, it's important that we have a really good understanding of what's going on. So what I want to do is just give folks a little bit of a quick catch up on where we are. Now, if we just take a look here, now let me just show you here. Right, if you take a look at markets, what you can see is stock markets started to fall quite significantly a week ago Friday, when we had that news that Silicon Valley Bank was struggling to pay its depositors. It'd taken out a number of US treasuries and it had to sell those US treasuries before it came to the maturity. And as a consequence of those purchases that Silicon Valley Bank has made, when they paid back depositors who suddenly wanted their money back, they had to close those positions at a loss, and so they had a liquidity crunch and they couldn't pay back the depositors quick enough. So of course, when depositors are worried and they don't think they're going to get money from their bank, of course everyone wants to withdraw their money at the same time, so there's a run on the bank. The Fed ended up backstopping Silicon Valley Bank, and that was on that weekend across the 11th and the 12th of March. Now, when markets opened, you can see that there was heavy selling across Europe, across the FTSE 100. You can see here, impacted particularly badly in the FTSE, and US equity markets as well. That's what you'd expect, and volatility pushing higher. Then, to make it worse, Credit Suisse got in trouble over in Europe, and it ended up with Credit Suisse being taken over by UBS. So when those major banks are getting into trouble, investors started to fear that there's going to be a big global slowdown, potentially a repeat of the global financial crisis. And so seeing major US and European banks in trouble really spooked equity traders. So we saw heavy selling. We've got some confidence returning. Now, it's not a complete confidence, but what investors have essentially been saying in equity markets, and markets have been quite mixed in terms of risk. We are sort of leaning more risk positive today, but you can forget that because it's all going to change with the Federal Reserve meeting, and that will set the tone. But what investors have really been saying, okay, there's not the immediate contagion fear. So that's the important thing to realize, that no matter what the Federal Reserve do tonight, if another bank ends up being in a crisis mode, then expect equity markets to sell off sharply. Equity markets are very afraid of a contagious banking crisis. It tends to ripple through the whole economy, and one bank's collapse impacts another bank's balance sheet. It can also result in a huge credit crunch as people don't want to lend money out, and it can really hinder global growth. So investors really fear another banking crisis. For now, markets are saying, okay, we accept that the Fed's backing up Silicon Valley Bank, Signature Bank. The Swiss National Bank is providing liquidity for UBS as they take over Credit Suisse. Calm. Now that can change on a dime. So be aware that that's very sensitive reactions to any banking news at the moment. As long as things continue as they are, contagion fears will keep gently moving back. If you're sort of watching this and thinking, oh, I don't know how to keep on top of that narrative, Giles, just look at the VIX. Because if the VIX moves lower, that's showing confirmation that banking fears are fading. If the VIX moves higher, that's most likely going to be because banking fears rising. It's certainly signs of distress. So just pull up the VIX and keep an eye on it. And when it moves sort of up above 25 and up towards 29, you can see that's signs of distress. And if you look at the VIX, when the VIX rises, that's naturally weighing on equity markets to the downside. And all the VIX is, it just shows you that S&P 500 traders are increasing their put options on the S&P 500, insuring against downside. So that's all it is. So when you see the VIX rising, it's just put options are increasing the S&P 500. And of course, you know, you only do that when you're worried. So rising VIX, falling S&P 500, rising VIX, falling S&P 500, rising VIX, falling S&P 500. S&P 500 here is in the gold line. Okay, so just look at the S&P 500 and the VIX, and the VIX itself will just keep you, you know, attuned. Commodity markets, right? Mixed bag here. Let me explain why. Gold and silver absolutely surging over the last sort of 10 days or so. Now that's because real yields have been falling while the dollar's been falling. Why is real yields been falling? All real yields is a nominal bond yield minus inflation expectations. So of course, with markets thinking, oh, the Fed will have to be slower in hiking rates, that means the yield has fallen because inflation has remained the same. And if we just take a look at inflation data in the US, we can see that inflation data, look, is elevated. There's the headline inflation data, 6% year on year, and the core inflation data, 5.5% year on year. Just zoom out the chart, you can see that that's very high levels, okay? You know, if you look over the 10 years, highest levels over 10 years, highest levels since, you know, at least 2000. So core and the headline for the inflation, headline, highest levels, you know, since 2000. So as yields fall sharply, and you can see here, bond yields have been falling sharply here, right? And notice that fall in yields was on the same time as we saw the collapse in equity markets. Why? Because bond traders says, oh, slowing US economic growth, credit crunch, collapse in the bank, the Fed won't be able to hike interest rates as aggressively as we thought, so yields drop. So that move in yields lower alongside the dollar is what's been supporting both gold and silver. So we'll come to that later. Bear that in mind because that's a potential trading opportunity for the Fed later. WTI and Brent crude, again, if you look at Brent crude, if you go back to the global financial crisis of 2007, 2008, do you see how crude prices fell from $145 a barrel down to $33 a barrel, right? And that's what investors were freaking out about with the latest move lower in WTI crude. Uh-oh, banking crisis. Uh-oh, replete of global financial crisis. Sell oil now, ask questions later. Oil's finding a little bit of a base with the same sentiment that's lifting equity markets. Panic button has gone. And if you look at WTI oil, you know, you just see that there is some pretty decent support around the 100, 200 exponential moving average, right? Which you can just see here in that big support. This is a big level of support that I had marked, expecting, a bounce and buyers at this level. That's what we've got. Big focus now will be on the Federal Reserve, and wouldn't be surprised to see oil just carry on its merry way back up. This is a major trend line to be testing, so watch out for that. Latest OPEC news, they're maintaining OPEC production cuts of 2 million barrels per day all through 2023. Latest sources report, just saw that before the webinar. Where is it? Yeah, OPEC reportedly like to stay the course on 2 million barrel per day production cut until the end of 2023, despite price drop, according to 3 OPEC delegates cited by Reuters. So they're keeping production cuts in a place. OPEC do a pretty good job of supporting oil markets. The copper markets moving lower. Dr. Copper gives you an indication of what investors are thinking about global growth. And obviously, if there's a huge banking crisis, then copper markets will fall. They've been rising alongside equity markets, just on the banking contagion fears fading, and it's big focus now what the Fed do. Now, bond yields, we've covered that. Bond yields around the world dropping. Why? Because interest rate expectations changed across the world as soon as that as soon as that banking crisis emerged. So lower interest rates expected from all major central banks. That's what's impacted the bond market. The dollar has been moving lower in the near term, right, on expectations of a less aggressive Federal Reserve. So that's just been weakening the dollar. Be aware of this. This could change. We might see some dollar strength if we see the Fed change their policy. So with dollar strength suddenly coming back in and a more aggressive Federal Reserve, or we can see dollar strength on global growth slowdown fears. So remember the dollar smile theory? Let me just show you this. This is on my blog. Make sure you've got this theory down. It's called the dollar smile theory. Let me see. I think I've written about this before. See, I'm pretty sure I have. There it is, right. So you see the dollar tends to appreciate in 2 different environments. One, if the US is, economically doing better than the rest of the world, you see the dollar gain. If there's a global slowdown or a US recession, you can see the dollar appreciate. When global growth is sort of happening together, then you see the dollar tends to appreciate. Now, the reason for this, if you think about it, it's quite logical. If you're a US investor and the US is doing well and the rest of the world's doing well, what do you do with your dollars? Well, you invest it across the world. You'll invest it into other economies, particularly into emerging markets. You'll be quite happy for your dollars to move from the US out of the rest of the world into other currencies, and so you see the dollar depreciate. And then when global growth slows down, what do? Oh, I'm going to bring my investments back. So dollars come back into the US. And that smile theory, keep that in mind, just helps understand what's going on. But at the moment, okay, the dollar's weakening just at the moment on the rate repricing. Okay, so that can change. Right, with all this being said, we've got the context. Now, what's expected? This is important. Let me just check. There's no question. Oh yeah, hi Charles. Yeah, pound went wild over CPI. Yeah, it's worth just covering actually. Oh, that's interesting. Charles, there's an average of 60 banks a year go bust. Yeah. 2 and 10-year yields rising should affect silver. Yeah, silver's an interesting one as well. I was long silver early in this crisis. Right, let's have a look. Yeah, so what Charles points out is worth just quickly looking at because it just shows you. You see that UK inflation print? Do you see how it came in across the board, much higher than expected? Look, headline, year on year, coming in 10.4%, higher than the 9.9% expected, higher than the prior 10.1, not as high as the 11.2 October 2022 high, but still very high. Core, higher. Do you see that little lightning next to each inflation print? that's above market's maximum expectation. So the maximum that economists were forecasting, CPI beat it. And the currency pair to trade that with was the euro pound. And there probably is still, at the moment, a euro pound short bias. So it was a euro pound short bias. And, you know, if you get any deep retracements up in that euro pound, you know, it's not unreasonable to be selling euro pound for market, looking for a move back down to that 8,770 region and then down to that S1 stop just above the high. That would be an intraday position that would be reasonable. I'm personally not taking it. I've got the Fed coming up later, but that would not be a bad expression, because expectations will be that the Bank of England will need to hike interest rates for sure tomorrow. That's just what's the repricing that's taken place. And now expectations are like nearly 100% for a 25 basis point rate hike, whereas prior to the meeting it was more 50-50. Now it's like nearly 100%. Okay, so that's why we expect the pound to strengthen into the Bank of England meeting tomorrow. Now, let's get back to the Fed. Now you can see here that markets are expecting a 15% chance of no rate hike and an 85% chance of a 25 basis point rate hike. So that's now the consensus view. So markets are saying we're expecting the Fed to hike by 25 basis points. But look at the pricing here. If you look at the current pricing, you can see that in short-term interest rate markets are expecting the Fed to cut once or twice into the end of the year. So they're expecting a rate cut with a terminal rate of just under 5% and down to just under 4.5% for the year end. That's what's sort of priced in, right? Now, if you look at the dot plot, this is called the summary of economic projections, right? This report. And this is where we get the dot plot. You only get it a few times a year. And we get a summary of economic projections today, right? So if you just take a look here, you'll see on the decision meeting, you've got this summary of economic projections that is anticipated. The economic projections, right? Just going to turn my phone off. Right, sorry about that. Those economic projections are due to come in today. Now, if we look at the last economic projections, they were a while ago, okay, in December. But what was interesting, they saw a median plot of 5.10%, terminal rate 5.10, and no rate cuts at all until 2024. The question now is what will they signal in the dot plot? That's what I want us to look at. So for the decision later on, we need to be aware that yes, if they hike by 25 basis points, that's what's expected. It's expected by short-term interest rate markets. It's expected by economic projections. So it won't be a surprise. A rate cut will be slightly a surprise, but still some economists are projecting it. So it's not a total surprise. So what we want to look for, I'm expecting the interest rate decision to be on hold, right? Or a 25 basis point hike. So if they hike by 25 basis points, that's kind of what's expected. Then it'll all come down to the economic projections. So then look at what the dot plot indicates. Does the dot plot start indicating rate cuts this year? So that would be these dots looking more like that 2024 print. So that looking more like this. So maybe, you know, a median rate of like 4.5 or something like that. And that would be in line with short-term pricing, which is seeing the Federal Reserve hiking once or twice by the end of the year. So look at the dot plot. That will be really crucial. So if the dot plot remains high, and they hike by 25 basis points, that tells you the Fed is still expecting to keep hiking interest rates, and that could result in equity markets selling off sharply. So the way I'd express trading this is trading the S&P 500. You could also use the NASDAQ because it's very sensitive to rates, and you can also use gold. Okay, so if I see a 25 basis point rate hike, I'll then go straight to the dot plot. If the dot plot shows, much lower interest rates, a medium of about 4.5, and they start looking at, 1 or 2 rate cuts into this year, then I would expect that to support the S&P 500 higher. Basically, the lower those dots, the better that is for stocks, because it means the Federal Reserve has peaked their interest rates and they're looking at about to enter into a rate cutting cycle. So that's what I'm looking at for the Federal Reserve. Now, the next element to look for will be the Fed press conference taking place half an hour later. Now, there's so many moving parts out there right now. You've got these banking contagion fears. You've got the worries about US inflation. How sticky is it? You've got uncertainty about what the Fed's going to do. This crisis developed, right in the middle of the Fed's blackout period. We haven't heard from the Fed. One commentator that is seen as a Fed whisperer is a Wall Street journalist called Tim Rayos. Okay, and Tim Rayos, let me just show you. He's seen as kind of an informal mouthpiece of the Federal Reserve. So he's recognizing. I'm seeing if there's anything he's saying. Right. So they're saying Fed faced one of its toughest calls in years. Whether to raise rates again to fight stubbornly high inflation or take a timeout amid the most intense banking crisis since 2008. It's going to be a tough decision with very tricky communications. Right. So he's basically as unsure as everyone else. So there's nothing particularly insightful from that. That's what we already know. It's going to be a tough call and a tough decision. So what that means for us and for me trading is that anything that you see move from 6 o'clock can reverse at 6:30. You must be aware of that, because the interest rate decision, the dot plot, and the press conference are 3 opportunities of communication. So if you and I were a central banker, you'd want to use that. So if you see the market react extremely at 6 o'clock to the dot plot and the interest rate decision, you then have the press conference to change that. You could say something to contradict it. So given the uncertainty, watch out for what the Fed does. But over all of this, remember, fresh banking crises will result in stocks falling. The risk here is actually, this is quite a bearish bar that's been set. Look, quite low interest rates, only 25 basis point rate expected, terminal rate of 5%. So the risk here is the Fed is more hawkish. If the Fed are more hawkish, that would be dollar strength, that would be gold downside, that would be S&P 500 downside. So in summary, this is what I'm looking for, but don't forget, you've got to remember the press conference at 6:30 because it could be reversed. The most dovish situation. A dovish situation is S&P 500 upside, gold upside, and Euro US dollar upside. So that would be on hold rate decision. That would be a dot plot, moving the dots, falling lower, Powell stressing concerns over the banking crisis and reassured that inflation is being beaten, right? That would be the most dovish reaction. That would be S&P 500 long, gold long, Euro US dollar upside. And the way to manage it, just managing it with daily pivot points, looking at key pivot points as areas to take profit on the S&P 500, on Euro US dollar and gold. It would also be upside for oil because the weak dollar would lift commodities. The most hawkish reaction would be if it's a 50 basis point rate hike, if the dot plot shows anything that's higher than this December dot plot or equivalent. So if they say no rate cuts this year, and if they say in the press conference, Powell stresses inflation fears and plays down banking woes. That would be the most hawkish decision. That would be dollar strength, gold downside, oil downside, S&P 500 downside. So that is the things to look for. All right. Okay. Now let me just see my right. My apologies. My control panel has froze. Ah, there we go. It's better. Yeah, Charles says, will UK economy ever slow regarding expectations? Will UK economy ever slow regarding expectations? Yeah, it's just so, I mean, the FTSE 100 has been so heavily sold compared to other major indices that I still see it as good value. I did personally buy into the FTSE 100 on this recent dip lower. I just think it's really good value. Just because, you look how, contained the FTSE 100 has been over the last sort of 5 years, despite all the COVID support, Brexit woes, political woes, all been weighing on the FTSE 100. So this dip down, I just took as a buying opportunity, and made sense to buy there. So depressed the FTSE 100, it's hard to see it getting worse, Charles. So that's been my take on it, for better or for worse. The what's going on here? Why is this keep? Right, there we go. Yeah, it has been stronger than expected. We're going from a very low bar. Dot plot, Charles says, dot plots after 1 day of posting mean little as participants don't have good track record. Yes, of course, it's not something that you use as, something set in stone. But what it does, and this is not for you, Charles, I know you know this, but for the rest of us, this doesn't, and it's a good point you raised, this doesn't say what the Fed will definitely do. What this shows is what the Fed are expecting to do as of today if things don't change. So the dot plot will just see, this is the crucial thing. How worried are they? It will show up in the dot plot because they might try and reassure us with a 25 basis point hike and say, it's fine, the banking, woes are contained, it's all fine. But the dot plot will reveal any true fears. Because if they suddenly see rate cuts, 2 or 3 rate cuts this year and significantly lower rates in 2024, that'll tell you they're actually quite afraid. So I'm using the dot plot to give me the true sentiment of how the Fed are feeling. And look, this is as much a feeling than an economic projection. Things like consumer confidence in the banking system. A lot of this is, very ethereal, not necessarily tangible. And consumer confidence is as much about psychology as anything else sometimes. There is not only pure economics, there's behavioral economics. And we're getting into that kind of area. It's a very difficult area to pin down. But confidence is a difficult, how confident are you feeling? How do you assess that? I'm sure there are ways, but what I'm trying to say is it's a tricky area. So I'm using the dot plot really to give me a sense of how confident they're feeling. That's the way I'm seeing it. Yeah, Kingsley says, how does one learn market sentiment? Great question, Kingsley. Think a bit like this. We understand what the mood of a person is, like a family member. You can come home and you can see, oh, my wife's in a good mood, I can tell. or my son's in a good mood. I can tell they're in a good mood because, you know, and then you might talk with them and say, okay, my son, you know, got a really good result in his, you know, in his school work today. So of course he's in a good mood. Or my wife's really happy because, you know, she had a really nice, you know, meal with her mum or something. You know, we can tell the mood of the people close to us, right? If you take that, Kingsley, that idea, and translate that into the market, then that's easy, right? Because so you can see, like, what's the mood of oil markets at the moment? You can see oil markets are feeling like they're feeling positive around risk because they're thinking the banking crisis is being contained. That recent sell-off seemed a bit extreme. Price fell into support. Similarly with the S&P 500, you might think, well, what mood is it? It's a tentative mood today. Why is it a tentative mood today? Because the Federal Reserve is meeting later, and look, it's right at the point of control on the daily pivot point, right? The daily point of control, and you can see that the S&P 500 is kind of in that kind of not wanting to sell, not wanting to buy. It's a kind of holding in different mood. Whereas yesterday we saw the S&P 500 was on a risk positive mood. Why? Banking fears were contained. Expectations that perhaps the Fed may be more dovish, you know, just supporting the S&P 500 through the day. Look at the euro pound, Kingsley. The sentiment in the euro pound is negative. Why? Because we had that very strong CPI data out of the UK, which means that the euro pound is likely to find sellers because the pound should gain on expectations shifting that the Bank of England will be more likely to hike interest rates tomorrow. So that's why, you know, the bias was to sell the euro pound. We moved up to that, look, that big round number 8800, and we're looking to sell it, and then, you know, potentially you can take in profit at 8775. If that breaks, then it's down to the S1 pivot point. You see, it's the mood. What's the mood of the euro pound today, Kingsley? Oh, it's in a bad mood. It's selling off because of that very hot UK CPI print that we've just had. And we just take a look at the UK, for instance, you can see, you know, headline inflation come 10.4, ticking up, and the core as well, you can see, look, ticking up from 5.8 to 6.2. That means expectations are that the Bank of England is going to be more likely to hike interest rates tomorrow. Look, lo and behold, expectations rising, nearly 100% chance of a 25 basis point hike. So the pound gains, right? And euro doesn't have any particular relevant news out today, so we compare the euro against the pound. You could have also looked at the pound US dollar as well. Kingsley, I hope that helps, okay? I hope that does help. Right, that's great. Yeah, you got it. Think of it like a person, and then think what mood is the market in today, and use that later when you're analysing what the Federal Reserve decide. Think, well, what mood will this put the stock market in? Think of it like a person. That's what sort of I think is a helpful, you know, way to think about it. Folks, been a pleasure as always. It's gonna be a wild one for sure. Expect significant volatility tonight. Remember, don't get caught out. You've got not only the dot plot, not only the interest rate decision, you've also got the press conference. That's where you could see, you know, initial moves contradicted. So be nimble, be alert, and manage risk very carefully. Take care, and I'll be back on Monday for the next edition. Take care, everyone, and thank you all very much. Trade safe, and look forward to speaking to you later. Thanks, everyone. Now, goodbye.